Good morning, participants. If you don't have any problem with the audio or video transmission, we'll start the session. So please point out if you are having any problem. Today we'll start on lesson 3, which is basically deals with the preparation and presentation of the financial statements. That will be topic for the lesson 3. So we are basically going to deal with a very important accounting standard, the first standard, that is IS1. We have talked about various international accounting standards during the course. So far we have covered. But today we are going to discuss the International Accounting Standards 1. It is the first and foremost standard providing guidelines on the presentation of general purpose financial statements to ensure comparability both with the entity's financial statements of previous periods and also with those of other entities. The purpose of the International Accounting Standard 1 is to provide guidelines on how to present the general purpose financial statements, which will ensure comparability both with the previous financial statements of the same entity or with the financial statements of other entities. So we will try to identify the objectives of financial reporting in the global scenario. We will try to understand also the key element in the complete set of financial statements as per IS1. How to present and disclose the requirements in case of statement of financial position or balance sheet or statement of other comprehensive income, and the difference between IFRS and US GAAP so far as presentation of financial statements are concerned. So IS1 provides overall requirements for the presentation of financial statements, guidance on their structure, and the minimum requirements for their content. So overall requirements of the presentation of financial statements, guidance on the structure of the financial statements, and minimum requirements for their content. That is what IS1 provides guidelines on. IS1 also prescribes the components of the financial statements that together would be considered a complete set of financial statements. So what really constitutes, or what are the various components of a complete set of financial statement? IS1 also prescribes what should be the components of a complete set of financial statements. I use the word general purpose financial statement. What does it mean? It means statements which are intended to meet the need of users who are not in a position to demand reports that are tailored according to the information needs. The users who are not in a position to demand reports that are tailored according to the information needs, that means the general users who cannot really, like banks when they are providing a credit facility to a corporate, they can ask for reports which are tailored to meet their financial information needs. So something beyond the general purpose financial statements can be asked for by a bank which is considering lending to the corporate entity. So general purpose financial statements are basically the kind of statements which are available to the ordinary users, general users. Now, what are the elements of a financial statements? What we find in a financial statements? What are the important elements of financial statements? So you can categorize the elements of the financial statements into 4 types. So IS1 recognizes basically 4 elements that constitute the financial statements. One element is asset. The definition of an asset, we have already covered it earlier, but we will reiterate it. A resource controlled by an entity, result of past event, and expected to provide inflow of economic benefits. So 3 characteristics of assets: it's a resource controlled by the entity, it is a result of a past event, and third, it is expected to provide inflow of economic benefits in future. These 3 characteristics relate to assets. Then another important financial statement element is income. So how we define income? It is recognized increase in asset or decrease in liability in the current reporting period. Any recognized increase in asset or decrease in liability during the current reporting period is considered an income, and the effect of income is it results in increase in equity. It results in increased equity. That is how we look at income. Income is something which increases the value of the asset or decreases the liability during the current reporting period, and it results in increased equity. Then the third element of financial statement is liability. Liability represents present obligation. It also arises from a past event, just like assets. Asset is a resource controlled by the entity. Liability is a present obligation. It arises due to past event, and it results in expected outflow of economic benefits. So due to a liability, there will be an expected outflow of economic benefits. Economic benefits will be outflowing, going out. Then we come to the 4th element of the financial statement, which is expense. It is the recognized decrease in asset or increase in liability in the current reporting period and results in decreased equity. Income results in increased equity. Expenses result in decreased equity. So these are the 4 important elements of financial statements. The financial statements will find only these elements will be reflected in the financial statements, various financial statements. So IFRS recognizes 4 elements that constitute the financial statements: income or gain, expenses or loss. These are used for making the profit and loss statement or SOPL statement of profit and loss. And assets and liability, these are the financial elements we will find in statement of financial position of the balance sheet. So if you look at the various components of a financial statement or the statements which constitute a complete statement, complete set of financial statement, there are actually 6 components. So let's get acquainted with this 6 components of a complete set of financial statement. One is the statement of profit and loss, SOPL. Short name is SOPL. It provides information about the profit and loss made during a reporting period. So statement of profit and loss is a general purpose financial statement which provides information about the profit or loss, profit made or loss incurred by the entity during the reporting period. So it is basically revenue earned minus expenses incurred, which gives you the profit or loss for the reporting period. Revenue earned during the period minus expenses incurred gives you the profit and loss during the period. The second component of financial statements is OCI, other comprehensive income. This component of a complete set of financial statement provides information about the unrealized gains and losses during a year. Losses or gains which have not yet been realized during the reporting period, they are reflected in the other comprehensive income. So, what kind of gains they could be? It could be gain on property revaluation, it could be reclassification of adjustments, or there could be other items of other comprehensive income. So, gains on property evaluation, gains on asset revaluation, etc. This will be reflected in the other comprehensive income, information about the unrealized gains or losses during a year. So the expenses and incomes that do not go to the statement of profit and loss, this will be reflected in the other comprehensive income. All incomes or expenses may not go to the statement of profit and loss. There are certain incomes or expenses which may not be reflected in the statement of profit and loss. They will be reflected to the other comprehensive income. But together SOPL and OCI form income statement. They can be merged together and can be made into one statement. Instead of having two different statements, statement of profit and loss and other comprehensive income, we can have a single statement by merging both the statements in one statement. It is possible to have one single statement replacing these two components of financial statement, that is statement of profit and loss and other comprehensive income. We can merge them into one single statement. That is possible. Then the third component of the complete set of financial statements is statement of financial position, which is popularly known as balance sheet. The other name for SOFP is balance sheet. So whenever I use the SOFP, you should understand what I am talking of. I am talking of the balance sheet. Balance sheet provides information about the financial position of the reporting entity. Balance sheet is nothing but it reflects the financial position of the reporting entity on a particular date. So the elements which find place in the balance sheet are assets, liabilities and equity. The elements which are reflected in the balance sheet are basically assets, which I have defined already, liabilities and equity. Equity is nothing but excess of assets over liabilities. So these are three components of financial statements which we have discussed. What are the other three? I talked about 6 components of financial statements which make a complete set of financial statements. So what are the remaining 3? The next component of the set of financial statement is statement of changes in equity. It is called SOCIE, statement of changes in equity. This is the fourth component of a complete set of financial statements, statement of changes in equity. It provides information about all transactions that an entity had with its shareholders. The transaction of the entity with its shareholders are reflected in statement of changes in equity. So increase or decrease in the share capital, revaluation surplus, accumulated profits, profits paid as dividend, All these are reflected in the statement of changes in equity. Increase in share capital, buyback of share capital, revaluation surplus from revaluation of assets, accumulated profits over the years, and dividends paid to the shareholders out of the profits earned. All this will be reflected in the statement of changes in equity. The fifth component of financial statement is statement of cash flow, SOCF. Statement of cash flow. It provides information about cash generation and deployment in the business. How much cash has been actually generated during the reporting period and how it has been deployed. That information is available in statement of cash flow. So it basically in statement of cash flow, the activities of the reporting entity are broken up. The three main activities, which are operating activities, investing activities and financing activities. So cash generation and deployment under each of the activities are shown separately, and ultimately these are summed up to arrive at the total cash generated and deployed during the reporting period in the business. So statement of cash flow. And the last component of the financial statement which creates a complete set of financial statement is notes to financial statements. These are basically relevant additional information which are not covered in the other 5 financial statements for necessary information to the users, because there may be some additional information which may not be covered through this other 5 financial components of the financial statement. These will be given in the form of notes to financial statements, a very important disclosure requirement. This discloses the information which are not available through the other 5 components of financial statement. That is called notes to financial statements. So to make up a complete set of financial statements, we have got IFRS prescribes there should be 6 components of financial statements. Number 1, statement of profit and loss, SOPL, other comprehensive income, statement of financial position or balance sheet, statement of changes in equity, statement of cash flow, and notes to financial statements. So Pratibha, I am going back to the last slide as per your request. So I am taking you back to the earlier slide. So tell me when you are over, done with the earlier slide. So now we understand what are the elements of financial statement: income, expenses, assets, liabilities. These are the 4 essential elements which we use for creating financial statements. Now a complete set of financial statement must have 6 components as per IFRS: statement of profit and loss, other comprehensive income, statement of financial position, statement of changes in equity, statement of cash flow, and notes to financial statement. Other comprehensive income, O for other, C for comprehensive, I for income. So OCI, I am giving the full form of each of these. SOPL, these are the full form of those acronyms. SFPL stands for Statement of Profit or Loss. OCI for Other Comprehensive Income. These two can be combined into one statement. IFRS allows that. IS1 allows that these two, instead of two separate statements, we can have one single statement. The two can be merged into one statement. Then we have statement of financial position or balance sheet, statement of changes in equity, statement of cash flow, and of course, the last one is notes to financial statements, which provides additional information which are not disclosed through this first five. Additional relevant information not covered in the first five components of the financial statements. I hope that is clear to you. So you have to keep in mind, these are the 6 essential components of a complete set of financial statements. Apart from that, apart from these 6 components which constitute a complete set of financial statements, the annual report of the reporting entity, if you look at annual reports of any of the companies, now most of the companies having completed having already finalized their statement of financial, having completed the audits, etc., they have come up with the annual reports. Annual reports basically contains the complete set of financial statements along with some additional items which are not going to discuss in details. One is the independent auditor's report. So if you come across any of the annual reports of any of the companies, you can look for these things. These things will be available there. Apart from this 6 components of a complete set of financial statement, you will find additionally these things also independent auditor's report. This is a report given by the statutory auditors who audits the accounts of the companies. So their report will contain their observations, their qualifications, if any, made by them regarding during the audit of the accounts. So that is called independent auditors reports. It's a report given by the statutory auditors of the company, normally a chartered accountant firm who carries out audit of the company's accounts. Then we have financial review by the management or director's report. This is a separate report given by the management or the director. It basically tells about the past performance of the business and the future direction in which the business will move. So it's a report given by the director or the management to the shareholders of the company. It is called financial review by management or director's report. Then a report on the corporate governance, and lastly the risk review. So there can be 4 different reports in an annual statement apart from the complete set of financial statements, but we are not going to discuss these items in this course. So additional statement that forms an entity's annual report are basically independent auditor's report, management or director's report, corporate governance report and risk review report. Just for your knowledge and understanding, we are mentioning these things, but we are not going to discuss it in details. Now, what are the considerations, overall considerations in preparing financial statements? We have talked about various accounting principles and conventions earlier. In our lesson 1, we have discussed in detail the various accounting principles and conventions. So, these form basically the basis for preparation of the financial statement. So first one is the fair presentation. So fair presentation implies that the financial statements present fairly the financial position, financial performance and cash flows of an entity. The fair presentation means the financial statements are presenting fairly the financial position, financial performance, as also the cash flows of the entity. That is what fair presentation means. Going concern is another important basis that the financial statements going concern basis means that the financial statement should be prepared on a going concern basis unless management intends to liquidate the entity or cease trading or has no realistic option but to do so. So the going concern basis means financial statement should be prepared on the assumption that the entity is going to carry on the business for a long time. So this entity is a going concern. It will continue to do the business for a long time. So it should be based on this assumption, financial statements are prepared. But if there is a management is intending to liquidate the entity or cease trading, stop trading, or has no realistic option other than doing it, then going concern basis may not be applicable. If the management is faced with a situation where they have to liquidate the entity or stop trading or has no option other than doing it, then going concern basis may not apply. But normally, for preparing financial statements, the assumption is always that the entity is going to continue in the business for a foreseeable time, for a long time in future. That is another important basis. Fair presentation, going concern. Accrual basis of accounting, you all understand, excluding the cash flow statement, because cash flow statement is based on the actual, that statement actually provides information on actual cash generated during the reporting period and deployed during the reporting period. So except the cash flow statement, all other financial statements must be prepared on an accrual basis, whereby assets and liabilities are recognized when they are receivable or payable rather than when actually received or paid. So assets and liabilities get recognized when they become receivable or payable rather than when actually received or paid. So actual basis of accounting is followed in preparation of all financial statement except the cash flow statement. Then consistency, another very important, consistency of presentation. Entities are required to retain their presentation and classification of items in successive period unless an alternative would be more appropriate or if so required by a standard. So consistency of presentation requires that the reporting entities must retain their presentation and classification of items in successive periods. Same presentation and classification should be maintained in the successive periods unless an alternative would be more appropriate or unless it is required by a new standard. That is the meaning of consistency of presentation. That is a very important basis for preparation of financial statements. Materiality and aggregation, another very important basis for preparation of financial statements, which requires each material class of similar items shall be presented separately in the financial statement. Each material class or group of similar items shall be presented separately in the financial statements. Material items which are dissimilar in nature or function should be separately disclosed. So land and building cannot be clubbed with plant and machinery. These are materials of dissimilar nature. So each material class of similar items shall be presented separately in the financial statements, and material items which are dissimilar in nature or function should be separately disclosed. Then offsetting, another important basis, which says assets and liabilities, income and expenses cannot be offset against each other. You cannot offset an asset against a liability or an income against an expense unless required or permitted by a standard or an interpretation. So only if it is required by a standard or interpretation, then it can be done. Otherwise, there should be no offsetting of assets and liabilities against each other or income and expenses against each other. Measuring assets net of allowances. Sometimes we measure assets net of allowances, like presenting receivables net of allowances for doubtful debts is not considered offsetting. When you are making a subsequent measurement of certain assets like receivables, so you can measure it net of allowances for bad and doubtful debts. That is not considered offsetting. So measuring assets net of allowances, for instance presenting receivables net of bad debt allowances, is not offsetting. Another important basis is comparative information. Comparative information including narrative disclosure. That means narrative disclosure normally comes in notes to financial statements. So comparative information including narrative disclosures relating to the previous period should be reported alongside current period disclosures unless otherwise required. So in reporting the revenue expenses for the current reporting period, along with that you should also present the revenue and expenses relating to the previous period. So that enables a user to compare the revenue earned in the current reporting period with the revenue earned in the immediately preceding reporting period. So comparative information including narrative disclosures relating to the previous period should be reported alongside the current period disclosure unless otherwise required. And of course IFRS compliance. That means various accounting standards have to be complied with, are required to be complied with. So you have to, in preparation of the financial statements, the various accounting standards or IFRS should be complied with. Now we talk about the statement of financial position or balance sheet, one of the most important components of a complete set of financial statements. In the balance sheet presentation, current and non-current assets and liabilities should be classified separately on the face of the balance sheet, except in circumstances when a liquidity-based presentation provides more reliable and relevant information. So all current and, so there should be a distinction between current and non-current assets. So current and non-current assets should be presented separately in the balance sheet, so also current and non-current liabilities should be separately presented on the face of the balance sheet. But when liquidity presentation is more reliable and relevant, then it need not be done that way. So when an asset is considered a current, when you consider an asset as a current asset or a liability as a current liability, but we classify an asset as current when it is expected to be realized in or is intended for sale or consumption in the entity's normal operating cycle, or it is held primarily for trading, or it is expected to be realized within 12 months after the reporting period, maximum period of 12 months. So an asset is considered as current if it is expected to be realized in or is intended for sale or consumption in the entity's normal operating cycle, or if the asset is held primarily for trading, or it is expected to be realized within 12 months after the reporting period. So this is the test we apply for classifying an asset as current asset or a non-current asset. So if any of this criteria is met, like the asset is expected to be realized or is going to be sold or consumed within the normal operating cycle, or the asset is held primarily for trading purposes, or the asset is expected to be realized within 12 months of the reporting period, date of the reporting date. If any of these criteria apply to a particular asset, we will call it a current asset, otherwise it is a non-current asset. Or a current asset can also be cash or cash equivalent assets, unless it is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. Cash or cash equivalent can also be, all cash and cash equivalents are also taken as current assets unless there is some restriction for it being exchanged or used to settle a liability for at least 12 months after the reporting period. If such restriction doesn't apply, all cash and cash equivalents will be considered as current assets. Similarly, a current liability is a liability is considered as a current liability if it is expected to be settled in the entity's normal operating cycle, or it is held primarily for trading, or is due to be settled within 12 months after the reporting period, or which doesn't have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. Terms of a liability that can be settled with equity instruments at the option of the counterparty do not affect its classification. Even if the liability which can be settled with equity instruments like convertible debentures, etc. These are liabilities which can be settled with equity instruments to be issued by the issuer of the non-convertible debenture, and it is at the option of the debenture holder. So debenture holder has the option to get it converted into equity, then it will not affect the classification. Classification will remain same, so we will have to see whether it is going to be settled in next 12 months or not. Whether the liability is going to be settled in 12 months or in the normal operating cycle, and based on that criteria we will call a liability as a current liability, otherwise it will be non-current liability. So this is and all assets should be presented, all current assets and non-current assets should be distinguished and presented separately. Similarly, liabilities we should check whether the liabilities are current liabilities or non-current liabilities, and they should be reflected separately in the balance sheet, unless the liquidity presentation is more reliable and relevant. The minimum line items in a balance sheet, this is we are talking about the presentation and structure of the balance sheet as per IS1. Minimum line items in a balance sheet, these are the minimum line items required in a balance sheet. IS1 provides for the requirements of minimum line items that should be included in the balance sheet. Most or all of these line items we have already covered or would be covering during this course. If we look at most or all of these line items we have already covered during this course, or we are going to cover. But there are certain items that could be out of the purview of this course. Like say property, plant and equipment we have already covered, investment property we have already covered, intangible assets we have already covered, financial assets we have already covered, investment accounted for using the equity method we will be covering at some point of time, biological assets we have not covered, we are not going to cover it, inventories we have already covered, trade and other receivables we have already covered, cash and cash equivalents, trade and other payables, provisions we have already covered, financial liabilities we have already covered under financial instruments, liabilities and assets for current tax we have already covered, deferred tax liabilities and deferred tax assets we have already covered, minority interest presented within equity we have not covered it but we will be covering it at some point of time, issued capital and reserves attributable to the equity holders of the parent, that also will be covering during the course of. Biological asset we have not covered, not going to cover. Biological asset could be livestock, plants, various kind of biological assets are possible. Just to give you an example of the biological asset, a dairy farm, they have milk cows. These are biological assets. Livestock, poultry farm. These are examples of biological assets, but we are not going to cover biological assets here. So regarding minimum line items in a balance sheet, so we have looked at what are the minimum line items in a balance sheet as prescribed under IS1, and we know that many of these line items have already covered the accounting standards applicable for those line items we have already discussed in details. Notes are normally presented, notes to financial statements. How notes to financial statements are presented? Notes are normally presented in the following order, which assists the user in understanding the financial statements and comparing them with the financial statements of other entities. So there is specific order in which the notes to financial statement should be presented. First is the statement of compliance with IFRS. First, Note is the statement of compliance with the IFRS. Then second will be a summary of significant accounting policies applied. So the company will have to disclose, the entity has to disclose what are the significant accounting policies applied for preparation of the financial statement. Then supporting information for items presented in each financial statement like SOPL, OCI, SOAP, etc. So supporting information for items presented in each financial statement in the order in which each statement and each line item is presented in the statement. Additional information, supporting information for items which are presented in each financial statement. They will be presented in the order in which the statements have been presented, and secondly, each line item in the statement is presented. Then there will be other disclosures including contingent liabilities and unrecognized contractual commitments, and non-financial disclosures such as the entity's financial risk, management objectives and policies. That is how notes to financial statement should be presented. In this order, it should be presented first for a compliance, statement of compliance with IFRS, then summary of significant accounting policies applied in preparation of the financial statements, then comes the supporting information for items presented in the each financial statement or each component financial statement in the order in which the components have been presented and the line items have been presented in those components. Then lastly, other disclosures including contingent liabilities and unrecognized contractual obligations, and non-financial disclosures such as the entity's financial risk, management objective and policies. That is how notes to financial statements should be presented. So there is a definite structure for the notes to financial statements, you can see. Income statement presentation, what are the guidance? The guidance on income statement preparation is financial performance is presented in the form of the statement of profit or loss and other comprehensive income. So basically financial performance of the entity is presented through two different statements or one single statement which combines both the statements. So it's presented in the form of statement of profit or loss, SOPL and OCI. One statement, statement of comprehensive income. So when we combine SOPL and OCI, we can create one statement which is called statement of comprehensive income or SCI. So if these two are combined into one statement, that statement is called statement of comprehensive income, SCI. So one statement, statement of comprehensive income, or two statements. That is a choice of the reporting entity, either to present one single statement called statement of comprehensive income which combines both the statement of profit or loss and other comprehensive income, or they can present two different statements. One is statement of profit or loss, which is basically unrecognized, which is basically recognized income and expenses, and other comprehensive income is unrecognized income and expenses. Unrealized, sorry, not recognized. Unrealized, realized income and expenses are reflected in the statement of profit or loss, and unrealized income or expenses are reflected in the other comprehensive income. That is the difference. IAS 1 defines profit or loss as the total of income less expenses excluding the components of OCI. So unrealized gains or income or unrealized expenses or losses do not go into calculation of profit or loss. So IAS 1 defines profit or loss as the total of income less expenses, but here income means realized income, expenses means realized expenses. So IAS 1 defines profit or loss as the total of income less expenses excluding the components of other comprehensive income. OCI basically includes items of income or expenses including reclassification of adjustments that are not recognized in the profit or loss as required or permitted by other IFRS. So that is what is OCI. It only includes items of income or expenses that are not recognized in profit or loss as required or permitted by other IFRS, other accounting standards. The statement of profit or loss, we'll first discuss SOPL. IS1 prescribes line items for a profit or loss, for example, revenue and finance cost. So revenue, finance cost, these are the various line items of SOPL. The statements must present, till third cycle is already over. Third cycle test is already over, Sukhdeep Singh. It was due on last Saturday. It was scheduled on last Saturday. That is 6th of May. It was scheduled. Okay. IS1 prescribes the line items for profit or loss. The statement must present profit or loss, total other comprehensive income, comprehensive income for the period, an allocation of the profit or loss and comprehensive income for the period between non-controlling interest and owners of the parent. So if the company is owned by another company, then the allocation of profit or loss and comprehensive income for the period, reporting period, between non-controlling interest or minority interest and owners of the parent. As I know the schedule, it is 6th of May. It's already over. If you are getting the information 15th of May from somewhere, I don't know. But as per the schedule, I know it is 6th of May, it is already over. Date is already over. If you have some other information, you can rely on that information. Fine with me. Okay, Sukhdeep? So IS1 requests expenses to be classified by the nature of expense. You can classify expenses by their nature, like salary expense, depreciation expenses, advertising expenses, like that, or by functional classification, like say cost of sales, distribution, administration, etc. So expenses can be classified either by the nature of expenses, or they can be classified, there can be functional classification. Expenses can be presented by way of functional classification like cost of sales, distribution cost, administration cost, etc. Selling cost. So these are two alternatives available for presentation of the expenses. Either it can be done based on nature of the expenses or based on the functional classification. The minimum information that should be presented on the income statement as defined by IS1 is revenue, finance cost, share of profit or loss of associates and joint ventures accounted for using the equity method, which we will discuss afterwards under lesson 3. A single amount comprising the total of the post-tax profit or loss of discontinued operations, the single amount comprising the total of the post-tax profit or loss of discontinued operations, the post-tax gain or loss recognized on the measurement of fair value less cost to sell or on disposal of assets or disposal of groups constituting the discontinued operations. Then tax expense and ultimately profit or loss. So these are the minimum information to be presented to the statement of profit or loss as required under IS1. So you can have a look. Let's see. Let's look at a specimen. Consolidated income statement for the year 31st December 2009 for the entity. See, comparative information has been provided. So although our reporting period is 2009, 31st December, that means 1st January to 31st December 2009, the previous year figures are also given side by side. This disclosure is necessary. Okay. So see, first is the continuing operation. Revenue from continuing operations, sale of goods, rendering of services, revenue from redemption of goods or points, basically points, rental income. These are revenue from the continuing operations, revenue. Next comes cost of sales. So we arrive at the gross profit. Then other operating income. Next to that, note number is given. Notes to financial statement, under which note the details of the other more disclosures are available on the other operating income. So you have to look at note number 9.1 to look at the details of the or more additional information regarding other operating income, which may not be available from this figure here. So the notes to financial statements, there will be also the note number, the particular number and the para number under which the note is given, that also will be displayed. Then selling and distribution cost, administrative expenses. So here it is by functionality. The expenses are here presented by going by their functionality, like say cost of sales, selling and distribution cost, administrative expenses, etc. Then other operating expenses, again there is a note to financial statement under 9.2 para, it is available. Then finance cost 9.3 is a note to financial statements. Finance income 9.4. So if you want to get additional information on each of these items, you will get it by consulting the notes to financial statements, the relevant paragraph. Share of profit of an associate. Okay. So profit before tax from continuing operations. So we are getting profit before tax from continuing operations till this time. Then income tax expense. So profit for the year from continuing operations. Then discontinued operations. Discontinued operations will only have a single line item. Profit or loss after tax for the year from discontinued operations. So one single line item is there. Notes to financial statement number 11. So profit for the year is then calculated. Then it is broken up. How much of the profit is attributable to the equity holder of the parent company and non-controlling interest or minority interest. So the allocation of the profit between the equity holders of the parent and minority interest. 8232 total profit earned. How much of it profit is allocated to the equity holders of the parent, and how much of this total profit goes to the allocated to the non-controlling interest or minority interest. So this is a complete consolidated income statement or statement of profit or loss for an entity presented as per the requirements of IS 1. So the specimen is very important for you to understand. That's why I put the specimen on the screen. If you have any questions at this point of time, looking at the specimen, you can ask it. We'll have a short break at this point of time, and then we'll continue after the break. But please have a good look at the specimen, because it gives you the presentation of a financial profit and statement of profit and loss as per requirement of IS 1. So we are going to have a short break at this point of time. After that, we will resume again. Next we talk about the statement of other comprehensive income, OCI. Here items are classified according to their nature, grouped based on those that will not be reclassified subsequently to profit or loss. So you can have groups. One group are the items which are not to be reclassified subsequently to profit or loss. The other group may be consisting of items which can be reclassified to profit or loss when specified conditions are met. Income tax effects must be disclosed, net versus aggregate. If any reclassification adjustment are made, that must be disclosed. So items included in OCI are normally gains on property revaluation, remeasurement of defined benefit pension plans, exchange difference on translating foreign operations, and cash flow hedges. So these are the kind of things which are items which are included in the OCI, other comprehensive income. And as I told you, statement of profit or loss and statement of other comprehensive income can be combined into a single statement called statement of comprehensive income. Now we'll talk about the difference between IFRS and US GAAP. So for the presentation and preparation of financial statements are concerned. In both the frameworks, the components of a complete set of financial statements are same, except that IFRS requires, which is mandatory actually, the statement of changes in equity. For US GAAP it is optional. So in both the frameworks, in IFRS and US GAAP, the components of a complete set of financial statements are same, but in case of IFRS, statement of changes in equity is a mandatory component. It must be there. Whereas in the case of IFRS, US GAAP, it's an optional. So entity may provide statement of changes in equity, may not provide. Again, in both the frameworks, the financial statement presentation is very similar. Differences between the two tend to arise in the level of specific guidance. So the presentation of the financial statements are very similar both for IFRS and US GAAP, but the difference between the two arises in the level of specific guidance. Significant differences are balance sheet, statement of financial position. IFRS includes a minimum list of items to be presented, unlike US GAAP. However, SEC regulations have more detailed requirements than IFRS. So US GAAP may not require a minimum list of items to be presented, line items to be presented, but when you go to SEC regulations, then it has more detailed requirements compared to IFRS. So far as income statement is concerned, IFRS includes a minimum list of items to be presented, unlike US GAAP. Again, SEC regulators or regulations have more detailed requirements than IFRS in the case of income statement. IFRS prohibits extraordinary items, which US GAAP doesn't prohibit. US GAAP doesn't prohibit extraordinary items, but IFRS prohibits extraordinary items. IFRS doesn't define a certain key income statement measures. They do not define what is key income statement measures, while US GAAP doesn't define all these measures either. SEC regulations provide requirements and limitations on the ability of public companies to disclose non-GAAP measures. So these are the points of difference between IFRS and US GAAP. So far as presentation is concerned, financial statement presentation difference. Statement of comprehensive income. IFRS permits comprehensive income to be presented in one statement of comprehensive income or in two statements consisting of a separate income statement, statement of profit or loss, and a statement of comprehensive income similar to US GAAP. We are talking of the presentation. What are the presentation difference under IFRS and US GAAP? We have talked about earlier the preparation, now presentation aspect. Now IFRS permits comprehensive income to be presented in one statement of comprehensive income or it can be done in two statements, that is statement of profit or loss and other comprehensive income. So US GAAP also permits the same thing. Statement of changes in equity. IFRS doesn't permit the component of comprehensive income to be presented in the statement of changes in equity in lieu of the statement of comprehensive income as permitted by US GAAP. US GAAP permits that in lieu of the statement of comprehensive income, the components of comprehensive income can be presented in the statement of changes in equity. But IFRS doesn't permit that. Under IFRS, you have to provide statement of comprehensive income and also statement of changes in equity of resulting from those comprehensive income. As regards statement of cash flows, IFRS permits a choice of alternative for the classification of interest and dividend, whether it will be shown under financing activities or operating activities, etc. IFRS permits certain alternatives for the classification of interest and dividend, while US GAAP doesn't permit these alternatives regarding statement of cash flows. And as regards notes to financial statement, using IFRS, most companies will experience additional financial disclosure requirements compared to US GAAP. So the comparative standards between IFRS and US GAAP, basically which are the relevant standards under IFRS and US GAAP relating to various preparation and presentation of financial statements. IS1 regarding presentation of financial statements under IFRS. US GAAP ASC 205 regarding presentation of financial statements. IS7 regarding statement of cash flows under IFRS. IS8 accounting policies, changes in accounting estimates and errors, which we'll be discussing in our next lesson. IS18 revenue. IS33 guidance on earnings per share, which I'll also be discussing subsequently. IFRS 5 regarding non-current assets held for sale and discontinued operations, which we are also going to discuss during this course. And IFRS 1 first time adoption, which we may not cover under this course. Under US GAAP, ASC 205 presentation of financial statement, ASC 210 for balance sheet presentation, ASC 215 statement of shareholders' equity, ASC 220 for comprehensive income, ASC 225 for income statement, ASC 230 statement of cash flows, ASC 235 notes to financial statements, ASC 250 accounting changes and error corrections, ASC 260 on earnings per share, and ASC 505 on equity. These are the relevant standards under IFRS and US GAAP for preparation and presentation of financial statements. So we have so far discussed what are current assets and current liabilities, what are non-current assets and non-current liabilities. But this should be classified separately on the face of the balance sheet, except in circumstances when a liquidity-based presentation provides more reliable and relevant information to the users. Financial performance is presented in the form of statement of profit or loss or other comprehensive income, two statements, SOPL and OCI. IS1 defines profit and loss as the total of income less expenses excluding the components of OCI. IS1 requires expenses to be classified by the nature of expenses or functional classification expense presentation. Like it can be presented, it can be classified by like salaries, depreciation, advertising, etc., or functional classification expenses presentation like cost of sales, distribution, administration, etc. Any questions? Any questions on IS1? So far we have discussed under IS1. Because I am moving to another accounting standard, important accounting standard relating to accounting policies and how they are formulated by entities. the implications of changes in accounting policies and accounting estimates and how these are accounted for. And we'll talk about prior period errors and how the prior period errors are corrected. So three things we'll be considering here or discussing here. One is regarding accounting policies, how they are formulated and applied by entities. The implications of changes in accounting policies, accounting estimates, and how these are accounted. And what are the prior period errors and how the corrections of prior period errors can be effected. So these are the points we are going to discuss in the current session. So we are going to discuss what is called IS 8, International Accounting Standard 8, which deals with accounting policies, changes in accounting policies and accounting estimates, and correction of prior period errors. So the objectives and scope of the IS 8 are basically selecting and applying accounting policies. Number 2, accounting for changes in accounting policies and accounting estimates, how these are accounted for in the books of the entity. And lastly, correcting of material prior period errors. So IS 8 prescribes criteria for selecting and changing accounting policies and the disclosures thereof. And also sets out the requirements and disclosures for changes in accounting estimates and correction of errors. So IS 8 basically prescribes criteria for selecting and also for changing accounting policies and how this should be disclosed. And also sets out the requirements and disclosure for changes in accounting estimates and correction of prior period errors. In doing so, it basically tries to achieve a few objectives. What are the objectives? To enhance the relevance and reliability of the entity's financial statement. Second objective is to ensure the comparability of the financial statements of an entity over time as well as with the financial statements of other entities. So you can compare the financial statement of the entity over a period of time. Also you can compare the financial statement of one entity with another entity. These are the purpose of the various guidance under IS 8. So we'll first discuss accounting policies. So what are accounting policies? These are specific principles, bases, conventions, rules and practices applied by an entity in preparing and presenting financial statement. So accounting policy is nothing but specific principles, bases, conventions, rules and practices which are applied by an entity in preparing and presenting financial statements. These are selected and applied by an entity. Entity can select the specific principle, rules, conventions, practices, basis, methodology, and application of generally accepted accounting principles. They can select and apply in preparing and presenting the financial statements. In case IFRS is insufficient in providing guidance or clarification in certain matters, then those can be selected by discretion. In case we find IFRS is silent or doesn't have any guidance or clarification in certain matters, it doesn't provide any guidance or clarification in certain specific matters, then this can be selected by discretion by the entity. So selection and application of accounting policies in the absence of a specific IFRS, the entity needs to use the judgment to develop an accounting policy using the following relevant information. First, they should refer to the IFRS dealing with similar and related issues. So an entity is selecting its accounting policies, and if they don't get a specific IFRS or accounting standards providing guidance on that particular matter, they should refer first to IFRS dealing with similar and related issue. May not be exactly the same matter, but similar and related issue. What does IFRS has to say on that? What is the prescription of IFRS? What is the guidance of IFRS? If that is not available, then they can refer to the framework, that is accounting concepts and principles. They can also consider the pronouncement of other setters like US GAAP or Ind AS, Indian Accounting Standards. They should try to see the pronouncement of other setters like US GAAP and Ind AS relating to those kind of issues. And they can also refer to the industry practices if it is consistently followed by the industry. So, using the judgment or discretion for selection of accounting policies in matters where IFRS has no specific guidance, the following steps can be taken by the entity. First, they should refer to IFRS dealing with similar and related issues. Or secondly, they can refer to the framework, that is accounting concepts and principles which are involved. Third, they can consider the pronouncements of the other setters like US GAAP or Ind AS on that particular issue. And they can also refer to the industry practices, what the other entities in the same industry are doing consistently. They can refer to the industry. And guidelines from IFRS, you have to follow this order in selecting appropriate accounting policies. This way IFRS is more flexible and requires discretion compared to the US GAAP, which is more rule-based. US GAAP is more rule-based. IFRS allows certain discretion, particularly when there is no specific guidance available under IFRS on certain issues, but even in selecting or making use of the discretion, these are the steps to be followed by the entity. Let's look at some examples on matters requiring accounting policies. What are the matters which require accounting policies? Like what method of depreciation to be used? Straight line method or written down value method? This is a matter of accounting policy. How the useful life of fixed assets determined? How the useful life of fixed assets will be determined? Which method of inventory valuation to be used? FIFO or weighted average method? How and when are bad debts and provisions for doubtful debts determined? These are the various issues or matters which require selection of accounting policies and implementing them. Like method of depreciation to be used, method of inventory valuation to be used, and determination of useful life of fixed assets, providing for bad and doubtful debts, or determining the provision for bad and doubtful debts. These are matters of accounting policies. So the entity must have certain accounting policies on deciding in these matters. This is only a very illustrative list. This is not an exhaustive list. I am not covering everything where selection and application of accounting policies are required. I am just giving you a few examples. But one thing is very important. Once an accounting policy is selected and adopted by the organization, by the reporting entity, it should be consistently applied over similar transactions from one accounting period to another. So entity has some discretion in selection of the accounting policies, adopting the accounting policies, but once a particular accounting policy relating to a particular matter has been selected and adopted, the entity should be the same accounting policy should be consistently applied over similar transactions from one accounting period to another. This is a consistency requirement, or a consistency in accounting policies must be maintained. Once selected, accounting policies must be applied consistently for similar transactions, other events and conditions, unless a standard or interpretation specifically otherwise requires or permits categorization of items for which different policies may be appropriate. If a standard or interpretation requires or permits such categorization, an appropriate accounting policy shall be again selected and applied consistently to each category. So So basically you have to understand one thing. One selected accounting policy must be applied consistently for similar transactions, other events and conditions, unless a standard or interpretation specifically otherwise requires or permits categorization of items for which different policies may be appropriate. In such an event, an appropriate accounting policy shall be selected and applied again consistently to each category. That is the requirement of consistency in accounting policies. Now question is, accounting policies can also be changed. It is not that once a policy is selected, it can never be changed. The changes in accounting policies can also happen. It can happen under two conditions. If it is required by a standard or interpretation or other statute, law. If it is required by a new standard or a standard IFRS, new guidance of IFRS under a particular standard or interpretation of a particular standard or other laws which may come into force, or if they provide more reliable and relevant financial statements. So an accounting policy once selected can be subsequently changed under these two conditions. Either it is required by a standard or an interpretation, or by laws enacted, other statute, or otherwise if change in the accounting policy will result in financial statements providing reliable and more relevant information to the users. Now the impact of a change in accounting policy, if the change shall be applied retrospectively. If an accounting policy is changed, the changes shall be applied retrospectively. That means we have to rework, the entity needs to rework its financial statements, its profit and loss, etc., applying the same accounting policy backwards. So the changes shall be applied retrospectively. The retained earnings prior to the earliest period presented should be adjusted. So when you make a change in the accounting policy, you apply it retrospectively so that there will be changes in the profit and loss of the earlier periods, which will also cause a change in the retained earnings. The retained earnings prior to the earliest period presented should be adjusted against the opening balance of the retained earnings. So the opening balance of the retained earnings should be adjusted with the revised retained earning balance by applying the accounting policy retrospectively. Example, if an entity adopts the revaluation model of the IAS 16, IAS 16 gives you two models for measurement of the property, plant and equipment. One is the cost model, the other is the revaluation model. So the entity which has adopted the cost model first as a part of their accounting policy, they change the accounting policy, then adopt the revaluation model. If the entity adopts the revaluation model of the IAS 16 for fixed assets, where the cost model was followed previously. So it's a change in the accounting policy. It should be applied retrospectively. Retained earning figures should be accordingly adjusted. The opening retained earnings for the period being presented should be adjusted by applying the change in the accounting policy retrospectively. Similarly, change in the inventory valuation from the weighted average to FIFO. If an entity was following inventory valuation using the weighted average method, now they want to change the accounting policy that they will be valuing the inventory using FIFO, first in, first out. This is a change in the accounting policy. It should be applied retrospectively, and the retrospective application would cause changes in retained earnings figure, and the retained earnings at the beginning of the relevant period should be adjusted accordingly. So we look at a statement of changes in equity to see how the changes in accounting policy affect how the retained earnings figure has to be adjusted and all of that. So we look at an example to see the effect of changes in accounting policy when applied retrospectively. This is an example of the format for the statement of changes in equity. This is the format in which statement of changes in equity is normally presented. So you have balance as at 31st December 2008. The various components of equity are there: share capital, share premium, revaluation reserve and retained earnings. So these are the four components of equity. Together, the total equity is 860. So 200 is the share capital, balance as of 31st December 2008. Share premium account had a balance of 70,000. Revaluation reserve balance is 80,000 and retained earning balance is 510,000. The total equity is 860,000 at the end of 31st December 2008. Now there is a change in accounting policy made in the year 2009. In the year 2009, a change in the accounting policy reduces the retained earnings by 60,000. So when applied retrospectively, it will cause the retained earnings to be reduced by 60,000. That is the retrospective application of the accounting policy will cause the profit and loss for the earlier years to be reworked, and as a result of that, the retained earnings will go down by 60,000. So changes in accounting policy is accommodated here in the next row. So change in accounting policy causes the retained earnings to go down by 60,000. So as a result, the restated balance of equity is 200,000 share capital, 70,000 premium, revaluation reserve 80,000 and 450,000 retained earnings. So total is 800,000. So we have to adjust the retained earnings, opening balance of retained earnings to 800,000. The slide shows how the presentation should be made for changes in accounting policies and prior period years retrospectively in financial statement, that is statement of changes in equities. Thus, the practical impact of this is that the corresponding amounts or comparatives presented in the financial statements must be restated as if the new policy had always been applied. The impact of the new policy on the retained earnings prior to the earliest period presented should be adjusted against the opening balance of the retained earnings. So this becomes the opening balance of retained earnings for 2009. Now during 2009, now we are looking at the statement of changes in equity for the year 2009. So first we made the adjustments due to changes in accounting policies. So the restated balance of statement of changes in equity, various components of equity as at 31st December 2009 has been worked out. That is the opening balance for 1st January 2009. And now during the year 2009, these are the various changes in equity. Share capital has been issued 80,000, share premium has been received against issuance of share capital 100,000, so total is 180. Dividend payments have been made to the extent of 90,000. So that is a reduction from the equity. Profit for the year is 155. That is added to the retained earnings. The dividend payment is out of the retained earnings. The profit goes to the retained earnings. Other comprehensive income for the year is 12,000, which is affecting the revaluation reserve only. So balance as at 31st December 2009 is for the share capital 200 plus 80 280. For the share premium 70 plus 100 170. For the revaluation reserve 80 plus 12 92, and for the retained earnings, the earlier figure was restated balance was how much? 450. So 450 plus 155 minus 90, so 515. And for the total equity, 800 plus 180 minus 90 plus 155 plus 12, which comes to 1057, which is also a total of the columns, various components of equity. So 1057 is the total equity at the end of 2009, that is on 31st December 2009. So this slide is basically to present you how a change in the accounting policy, how it causes, how it is reflected, the effect of changes in the accounting policy, how is it reflected in the financial statement, that is statement of changes in equity. Now we will talk about, apart from changes in accounting policies, there can also be changes in accounting estimates. So how they are treated? The impact of a change in accounting estimates is what? Whenever accounting estimate is changed, there will be certain impact. So what will be the impact? The impact of a change in accounting estimate can only affect change in net on profit or loss for the period of the change if the change only affects that period. If the change is going to affect the future periods, it will be accounted for also prospectively. So change in accounting estimate will not be applied retrospectively. That is the difference between effect of change in accounting policies and effect of change in accounting estimate. The impact of changes in accounting policies is always retrospective, but the impact of change in an accounting estimate is always prospective. That means it can impact or it can affect the profit for the reporting period in which the change was made. It can also affect the profits for the future periods, but it cannot affect the profits of the earlier periods. So that is the difference between change in accounting estimates and changes due to accounting policies. Sometimes it is difficult to distinguish whether it's a change in accounting policy or a change in accounting estimates. Sometimes there can be doubts over whether a change should be considered as change in accounting policy or a change in accounting estimate. So in case of doubts, if it is difficult to distinguish whether the change is of a policy or an estimate, then normally the practice is to treat the change as a change in the accounting estimate. So in case of doubts, always we treat the change as a change in accounting estimate and apply it prospectively. Only when you are certain that this is a change in accounting policy, then it should be applied retrospectively. Otherwise, if it is known that this is a change in accounting estimate, or it is difficult to distinguish or decide whether it's a change in accounting estimate or a change in accounting policy, we rather would consider it as a change in accounting estimate and apply it only prospectively. Now let's look at some examples of change in accounting estimate. We have talked about changes in accounting policies. Now let's look at what are the changes in accounting estimate. Some examples. Again, this list is the examples. These are only examples. So the list is really not exhaustive, only illustrative. Like say changes in the estimated useful life of properties, plant or equipment. So when a property, plant or equipment is acquired by a entity, every year the management will be reviewing what is the useful life of the particular item asset. So initially they may consider that the asset has a useful life of 10 years, but subsequently they can change the estimate that the useful life of the asset is 12 years. So this is nothing but a change in accounting estimate. So the changes in the estimated useful life of properties, plant and equipment is considered a change in accounting estimate. Changes in the method of depreciation, straight line method of WDV, it is not a change in accounting policy, it is only change in method of depreciation. It's change in accounting estimate. Similarly, changes in the provision for doubtful collection from debtors. That is also change in accounting estimate. Occasionally, it may be difficult to distinguish between changes in measurement basis and changes in estimate. Changes in measurement basis are changes in accounting policies, and changes in estimate are changes in accounting estimates. If there is a difficult to distinguish between whether it's a change in the accounting policy or a change in estimate, it is better, in such cases the change is treated as a change in estimate. And changes in accounting estimates are always adjusted prospectively in the period in which the estimate is changed. If relevant, if the change in estimate is also going to cause changes in profit for the future periods, then also the future periods profit will be affected. That much. But it will not apply retrospectively to the previous period's profit. Then the third thing we'll talk about is prior period errors. Now the errors, previous period errors have been committed earlier and detected now. So what happens to prior period errors? Errors basically could be in recognition, could be in measurement, something was recognized, not recognized. So errors in recognition, errors in measurement, errors in presentation. When you presented this particular item to the financial statement, there are some errors in presentation, the figures have not been correctly presented, or disclosure. So errors can happen in either in recognition or in measurement or presentation or disclosure. So prior period errors are basically omission and misstatements relating to the previous periods arising from a failure to use or by the misuse of reliable information. So prior period errors are basically omission and misstatement relating to the previous periods, earlier periods, arising from a failure to use or by the misuse of the reliable information. Some of the examples of prior period errors are: it could be effect of mathematical mistakes, it could be due to wrong application of accounting policies, it could be simply oversight, something has not been noticed, it could be due to deliberate misrepresentation of facts or fraud. So prior period errors, there are some examples of prior period errors which can arise due to effect of arithmetical mistakes or wrong application of accounting policies or oversight, simply oversight, somebody failed to notice something. Some inventories are there in the godown, but nobody noticed that inventory which was lying in the godown. Misrepresentation of facts have been misrepresented, wrongly presented, or frauds. So errors can arise in the recognition, measurement, presentation or disclosure of items in the financial statements. If financial statements contain either material errors or intentional immaterial errors that achieve a particular presentation, then they do not comply with IFRS. Misstatements or omissions are material if they could either individually or cumulatively influence the decision of the users of the financial statements. Discovery of material errors relating to prior periods shall be corrected by restating comparative figures in the financial statements for the year in which the error is discovered, unless it is impracticable to do so. So if it is practicable to do so, discovery of material errors relating to prior periods shall be corrected. If it is not practicable to do so, it may not be corrected. But discovery of material errors relating to prior periods shall be corrected by restating comparative figures in the financial statements for the year in which the error was discovered, unless it is impracticable to do so. Error in counting of inventory items, the other examples of prior period errors are error in counting of inventory items, spares and tools in the previous accounting period detected now. So there was an error in counting the inventory items or spares or tools in the previous accounting period which has been discovered now. Embezzlement of cash equivalents in the previous accounting year 2012-13 discovered in the current year 2014-15 after one more year. 2012-13 some embezzlement of cash equivalents were made by somebody, some employee or somebody, and this has been discovered in the current year 2014-15. It is after lapse of one more year. So these are the examples of prior period errors. Now, how prior period errors should be corrected? If discovered, how they should be corrected? Correction of prior period errors is retrospective. Just like changes in accounting policies, will apply it retrospectively to rework the profit figures of the earlier years. Similarly, correction of prior period errors is retrospective in first authorized financial statement after detection. The first authorized financial statement which comes out after detection of the prior period errors, we have to restate the comparative amounts for the prior period presented in which the error occurred, and the opening balance for the earliest prior period presented if the error occurred before the earliest prior period presented. So the error has occurred in 2000, like say earlier example, embezzlement of cash equivalent in the previous accounting year 2012-13 discovered in the current year 2014-15. Now, the opening balance for the earliest prior period presented if the error occurred before the earliest prior period presented. So 2014-15, the opening balance has to be restated. After taking into account the error that has happened, the opening balance for the earliest prior period presented if the error occurred before the earliest prior period presented. So 2014-15 is the earliest prior period presented. So in that year, the opening balance has to be restated. Let's look at an example to understand. This is regarding a change in accounting estimate. Let's look at this example. ABC Bank bought a machine in January 2011 for $5 million US dollars. 2011 January, they purchased the machine for $5 million US dollars. The economic useful life was estimated as 5 years, and the residual value as 0. In December 2013, that means at the end of 3 years, third year, the management thought that the projections for the machines were over-optimistic and the machine will not generate any economic benefit after December 2014. That means the useful life of the machine is only 4 years instead of 5 years. That the estimate that was made regarding useful life now gets changed to 4 years. And the scrap value will be 200,000. There is a residual value. Earlier there was no residual value. So at the end of 4 years, the machine will have a scrap value of 200,000. Suggest a way to deal with the scenario. So this will be dealt as a change in accounting estimate. Accounting estimate of the useful life of the machine, change in the accounting estimate of the residual value of the asset. So the machine was being depreciated over 5 years using straight line method. So every year 1 million was being depreciated. So machine was purchased in 2011. So written down value as on 1/1/2013 is 3 million, because 2 million has already been depreciated every year. 1 million was depreciated because the machine cost was 5 million. Useful life is 5 years. So every year the management was depreciating based on this estimate, the depreciating 1 million. That was the depreciation charge. For 2011 and 2012, cumulative depreciation for 2 years up to 31st December 2012 is 2 million. Machine's purchase price is 5 million, so the written down value of the machine as on 1/1/2013 was $5 million minus accumulated depreciation of 2 million, so it is 3 million. Now in December 2013, the management changed the accounting estimate that the machine will be useful for another 2 years. And the machine will have at the end of the remaining 2 years, the machine will have a residual value of 20,000, scrap value. So 3 million is the written down value of the machine, and at the end of next 2 years, that is 2013 and 2014, that is at the end of 2014, the machine will have a scrap value of only 200,000. So 2.8 million has to be depreciated over the 2 years 2013 and 2014. So we have to depreciate 2.8 million over 2013 and 2014. So each year the depreciation that will be charged will be 1.4 million. So the change in accounting estimate will be only applied prospectively. It will affect the profit of 2013 as well as 2014. The effect of the change in accounting estimate will be always applied prospectively, that is for the current reporting period in which the accounting estimate is changed, and maybe also for the future periods. In this case, it has to be also impacting the profit of 2014, because the depreciation will be now 1.4 million instead of 1 million for 2013 and 2014. So this is the effect of changes in accounting estimate. This is how it is dealt with. Is that clear, or any question you have got? If you are not clear on this particular examples I have provided regarding changes in accounting estimate, you can make your query. Please raise your query so that I can explain it to you again if necessary. Now we have talked about changes in accounting policy, changes in accounting estimate, and detection of prior period errors. How they are treated, how they are to be treated. Accounting policy changes will be applied retrospectively. Accounting estimate changes will be applied only for the current reporting period and for the future periods if it is relevant for the future periods. And for changes in detection of prior period errors, it should be applied again retrospectively. Now, disclosure requirements. Whenever a change in accounting policy is made, it has to be disclosed. So there is a need to disclose the nature and amount of the change in estimate or accounting policy. So in the form of notes to financial statements, etc., additional disclosures are required to be made if there is a change in accounting policy or change in accounting estimate. So there is a need to disclose the nature and amount of the change in estimate. When an entity restates, the IS1 requires an additional statement of financial position as at the beginning of the earliest comparative period. Whenever there is a restatement of the retained earning figures or things like that, the entity, the IS1 requires an additional statement of financial position or balance sheet as at the beginning of the earliest comparative period. When the change is caused, effect on the current and prior period should be disclosed. Effect that might happen on the future period should be disclosed. An amount of adjustment relating to periods before those presented will be disclosed. And if a retrospective application required but impracticable, the circumstances and description should be disclosed. So these are the disclosure requirements for changes in accounting policy, accounting estimate, etc. Its effect on the current and prior period must be disclosed. Its effect that might happen on the future period should be disclosed. Amount of adjustment relating to periods before those presented should be disclosed. And if a retrospective application is required but is impracticable to do so, the circumstances and description should be disclosed so that the users can understand why it is impracticable to make a retrospective application. So these disclosure requirements are there for changes in policy. So if you have any questions, you can ask at this point of time. So we have basically discussed IS 8, which deals with selecting and applying accounting policies, accounting for changes in accounting policies and accounting estimates, and correcting of material prior period errors. Please remember one thing, accounting policies once selected and adopted should be consistently applied over similar transactions from one accounting period to another. Correction of material prior period errors is retrospective in the first authorized financial statement after detection. And if a change is difficult to distinguish whether the change is a change in accounting estimate or change in an accounting policy, we should treat the change as a change in accounting estimate. If it is difficult to distinguish between a change in the accounting policy or accounting estimate, so then we will treat it as a change in accounting estimate and apply it only prospectively and not retrospectively. So these are the points to remember here. So if you have any questions, you can ask at this juncture. Otherwise, I will request you to complete your feedback for today's session. We will have the next session on Friday, same time. So please complete your feedback, and if there are any questions, please feel free to ask. Okay, there are two participants from Faridabad, Madhuri and Bharati. You are giving feedbacks that you have not understood the concept or your overall experience is not good. Why didn't you speak during the class? I never saw you raising any questions. I have been asking you if you have any doubts, clear it. Why you are not raising questions if you have not understood? Please respond to my question. So you are providing feedback saying that you have not been able to understand or the concept has not been clear to you. So why were you silent during the class? Did you raise a single question? Did you make a single query? So if you do not participate in the class and then say at the end of the session that I have not understood, that doesn't convey anything to anybody. Either you participate for your own benefit or don't participate. That's the best thing. This is not done. You are not participating in the class. Whenever we are inviting you to ask questions, clarify your doubts, you are not participating there. Now you give feedback that I have not understood. You are giving negative feedback about your overall experience. What is this? I'm asking Madhuri and Negi, the other person from Faridabad. What is this? Sukhdeep Singh, next class is on Friday, not Monday. We don't have classes on Monday. We have classes only on Wednesday and Friday. So I'm closing the session, but I don't like these things. Being silent throughout the session and then coming up with a negative feedback, this is not done. This is not the way you should participate in a class. Okay, since there are no other questions, I'm closing the session today.